Always difficult to come up and present when your year-end results are going to be out in 2.5 weeks' time. So I'm not going to spend too much time talking about the numbers and reiterating what came out in September. I encourage you to wait for the 20th of February when our year-end results are out. We will, however, just sort of touch on a couple of the highlights. And I think if we look at what the Karowe mine in Botswana has been able to achieve over the last sort of 5 years, it is quite a significant story. I mean, it's not just from the larger stones, it's actually what we've done with the money, how much of that we've actually spent on optimizing the recovery of value, the innovative processes which we've put in place to ensure that we recover money as early in the process as possible. And that's what has led to us being able to pay a significant dividend, now having returned around about 30% of our total market cap and more money than we ever raised to buy and build the plant back to our shareholders. And I think if we look towards the future, and the presentation which I'll be doing today will focus on what comes after the open pit. And we're quite excited, and I think that is going to be our focus through the back end of this year and into 2019. So when we do talk about that, we also have a small exploration play. As was mentioned in the previous presentation, there's very little that is actually being done. There are no new discoveries. And there's a lot of people that just aren't willing to spend money on diamond exploration when you're looking at a strike rate of 1 in 1,000 in finding an economic kimberlite. But again, it's the same as having a lottery ticket. If you don't have one, you're not going to win. So we do continue to do a small amount of exploration in Botswana, specifically focused on assets where historically in the late 60s, early 70s, they were identified as diamondiferous and just no work has been done on them in the past. And that's really where the Karowe mine came from. Something which was identified in 69 and then sat dormant for almost 30 years before De Beers and African Diamonds actually did the exploration. Again, we're looking at historical information. I think one of the things that the Lucara management is very proud of, we've had no debt since November 2013. And I think, again, just we had around about $54 million worth of debt when we started 2013, and it's the way we actually manage on-site costs. I can't tell you how much somebody is going to be willing to pay for a 50, an 80, 100, a 200, even a 1,000 carat stone. But one thing that we do control is the costs. And a couple of slides down will point out specifically what we're doing even before we get to those cost areas. One of the things where people stand up and they talk about sort of diamond pricing and what's happening in the diamond sector. And it always seems to be the beginning of the year, there's a liquidity event, there's availability of money, and diamond prices seem to go up. But if we look year on year, diamond prices have not been as stellar across the board. But when we look at the production profile which we have, and as we start to mine more and more material from the South Lobe, around about 80% of the material we'll mine this year will come from the South Lobe, we've actually seen sustainable growth in our average dollar per carat. But if you look at those numbers, especially the blue line, which talks to the percentage plus 10.8 carat stones which we've recovered. 2015 was just a complete anomaly, especially with a recovery of more than $200 million worth of diamonds in 2 days. But when we look at, and I encourage you if you're going to look at the financials, there's one number that you need to look at, and that's the average dollar per carat for 2017. And it's important to remember that 2016 was characterized by the sale of a fairly large number of those stones. And I exclude the Constellation and the Lesedi. Those are complete anomalies. They were recovered in November 2015. But I think when you look at that number, you'll see it's very encouraging to see continued growth in the average dollar per carat, regardless of what is actually happening to the market. And I think Johnny will second this as well. The production that our two mines have is very different to what you would generally see. And the challenge for us is that when De Beers comes out and they say diamond prices are down by X, we all get painted with the same brush. But our two production profiles is very, very different, and it's important to understand that. So the rest of the 5 minutes that I've got is going to be on the underground. The focus is all on the South Lobe. De Beers drilled that down to 758 meters, and we are sort of taking our time in ensuring that we fully understand the resource at depth. So the drilling was completed 10,000 meters to extend that pink section, which is the indicated ore, down to 400 meters to around about 600 meters. So about half of the, if not more than half of the blue will be put into pink. And that gives us sufficient resource to complete a pre-feasibility study. But because the market was quite anxious to find out what was down there, we did complete a preliminary economic assessment, which spoke to a underground mine, which extends the life of mine by an additional 10 plus years beyond the bottom of the open pit, which is currently scheduled for around about 2025, 2026. So this is what we're looking at. Again, it is preliminary a PEA, and we used sort of just standard industry practices when looking at the distance between the rim tunnels, the spacing between the crosscuts. We've got a twin decline down, most probably more than what we need. But again, we looked at this in a way which would guarantee that we could actually get in there. And now we go through the process of running the trade-off studies, understanding the geotech, and we've already committed $30 million for drilling this year to better manage the risks and understand both the geotech and the hydro. And anybody who's seen a project, and most projects, the one area that they get wrong and where it goes overboard in terms of capital costs is geotech. So we are spending a fairly large amount of money to understand that specific concept prior to actually finalizing both the pre-fees and then as we go into the fees. So we're looking at pre-fees most probably around about Q3 of this year, but a lot of the drilling which we're doing carrying on through the back end of the year and feeding into the feasibility study, which will come out next year. So just very quickly in summary, we're looking at a twin decline, one running down the east, one running down the west, 25 meter spacing between the crosscuts, and then 8 meter spacing, 25 between the rim tunnels and 8 meter spacing between the crosscuts. That's most probably the worst case in terms of the amount of development we're going to have to do. But because of the size of the kimberlite, we have just finished the trade-off study looking at the block cave. Would we be able to block cave? But I think for a mine like this, going out and spending $300-400 million on the development of a block cave, because of the value of the diamonds which we have, we'd prefer to move it into a sub-level open stoping for the first few years, then sub-level caving, because it's something that we can actually manage better on an ongoing basis. So when we now look at the economics of it, and again, I mentioned that it is PEA, the important thing to note is this block. It's the OPEX. It is the biggest thing that we can actually make an impact on. So with the preliminary geotech now being completed, the engineers are already saying that the distance between the rim tunnels, the spacing between the crosscuts can be significantly larger because of the characteristics of both the country rock and the kimberlite itself. And we're looking at anywhere from 30, possibly even 40 meters distance between the rim tunnels. And that's what Lucara does very, very well. We look at ways where we can actually affect the economics based on what we can actually control. And that's where we're working towards, is what can we do to reduce that big orange block, which is your OPEX, to ensure that we can continue to generate sustainable margins going forward. One thing which is important here, Botswana has a variable tax rate. And when we first looked at that in terms of the open pit mine and the profitability of the mine started to increase, we also noticed that we were paying a lot of tax. But you can actually understand now why the tax rate is actually there. The Botswana government is looking to get companies to actually spend money to enhance the longevity of their mines. And with that, what we did is we looked at what tax would we pay just to the end of the open pit. And then if we spent money on the development of the underground mine, what would that tax bill be? And we're looking at a net tax benefit of an excess of $230 million. That's what we pay less in tax. So if you do the math, whether we do the underground or we don't, we're not actually going to generate more money or less money. What we are doing is we're spending money to get an option for an additional 10 plus years of life of mine. And that's really how we're viewing it going forward. So I mentioned that we have committed $30 million for drilling this year. It is really to identify those key risks on the hydrogeological side. We do mine through 2 aquifers. All the drilling that we've done so far, where we were concerned about water, we've actually found 3 dry holes out of that. And I guess we have to thank De Beers again here. ORAP has been mining in the area for 40 plus years. They've actually got a well field between Letlhakane and our mine site, which is right on trend where the structural features sit. And they've done a great job in assisting us and providing us with the extension to our life of mine. So I'd like to extend a thanks to Deb Swana for that. But it's also the geotech. And as we go through the year, we're really focusing on managing our risk, doing those things which Lucara has done well, looking at innovative ways where the final solution is going to continue to add value, and we can continue to pay a sustainable dividend for many years to come. Thank you very much.